Alrighty guys, so first off here, public account's been red hot, unbelievable, right? Been red hot in general. How do you handle the emotions of that? How do you make something like this sustainable, right? Listen, in order to make anything sustainable in life, you have to take it out of a context of like, I'm getting lucky with this, and have a strategy, have a plan to continue to execute on something so it doesn't feel like luck, right? I'm sure there's plenty of people watching this video right now that, you haven't even researched companies. You don't know what you're looking at. You don't know how to run projections on companies, but you probably made a lot of money in the last 6 months, 9 months, year, 2 years, right? By just kind of throwing some money out there. Maybe you've been watching my videos, hearing the stocks I talk about, right? And you just kind of got lucky, right? You maybe bought a couple of my stocks and they went up a bunch, and next thing you know, you made thousands, tens of thousands, hundreds of thousands, or millions of dollars. And I bet you there's a lot of people watching this video right now that did exactly that. You didn't really do any research, and no, watching my YouTube videos, just hearing me talk about the stocks is not your research, okay? You didn't do any work on your own, and you're sitting in a situation now where you probably made a ton of money, and you're like, all right, man, I don't know how to keep this going, right? And so we got to create a sustainable strategy that is outside of just getting lucky, right? Of, trying to watch somebody on YouTube or CNBC or Bloomberg or whatever and just gambling some money out there and hoping you win, right? And this goes back to a point I was making in yesterday's video on the main channel around, people will spend so much time and thought into, a small expense. They'll go so out of their way to save, 20 cents on a soda, but yet it comes to actually putting in some effort and work into their investments, and they'll just put such little amount of time. And it's like, dude, this is your life savings. Like, this is your net worth. Why are you putting in such a small amount of work, right? Yesterday was a big day for the public count, closing over $4 million. Guess what I was doing last night? I was putting in the work. I was running projections. I was looking at market commentary. I was looking at some Fed-related stuff last night. At the end of the day, like, that's how you stay successful over time. You got to continue to put in the work. You can't just, get lazy like that. You get lazy, you get lazy results over time. Short term, anything can happen. Short term, over a 6-12 month span, you can get lucky doing this, doing that. But I can tell you, if you don't really actually put in the work, you don't understand all this stuff, it's going to come back to bite you in a massive way. And it doesn't come back to bite you when you're in a roaring bull market. It comes back to bite you when you start to get in a kangaroo market that's up and down and going nowhere. And then it comes back to really bite you in a bear market. And next thing you know, you end up losing all your gains. Because if you've been, as a human, if you've been taught, I can get lucky by just throwing some money in some stocks without really researching them in depth at all, running my own projections and things like that, why would you stop? You wouldn't. You do it on the next one, and next one, and next one, right? And that second one, or that third one, or that fourth one can come back to bite you. Next thing you know, you'll have lost all your gains, plus, you'll lose a bunch of money you had initially invested. That's what ends up happening if you don't know what you're doing in this game. So make sure you're creating a sustainable plan, right? Just yesterday was a big day. I ended up signing up 8 people. 8 people in my private stock group hit 7 figures plus in their portfolios. Unbelievable number, obviously, right? Those people are not just counting on getting lucky in the market and just like gambling money around. They have sustainable strategies. They go through all my course curriculums. They use 1000xstocks.com. They run their projections, and they build and they build and they build. And I'm sure in the future that a lot of those individuals will be at $2 million, $5 million, $10 million in their portfolio, right? Do you want to be a real player or do you want to be a fake player? It's up to you. You want to be a gambler or you want to be an investor? It's up to you. Those are your own decisions, right? Pin comment down there. Get access inside my private stock group, access to all his course curriculums, access to teach you this stuff on a high level, access to 1000xstocks.com. And don't let your emotions get the best of you in this game. Because if you let the emotions get the best of you in this game, you just got to be stoic, play it through, like understand what you're actually doing. And that allows you not to get emotional about this stuff, right? I understand in the future, there's going to be where day after day after day, the public count just goes down, right? And it's going to be a tough situation next bear market. That happens every bear market. And guess what? I'll be unfazed. Just like last night, hitting $4 million plus in the portfolio, I was unfazed. Today, the portfolio hits a new all-time high. I'm unfazed, right? Like, I could make, $100,000, $200,000. Monday alone, I was probably up a Ferrari. Unfazed. That's just the name of the game in regards to this, right? We're not playing this for fun. We're playing this for keeps, right? Now, let's talk about my potential hedges watch list here and, some stocks I might bet against and what I've been thinking about here, okay? Listen, There's a stock that's been on my potential hedges list here for a bit that I haven't bet against. I'm very upset I haven't, and it's Ferrari. Ticker symbol RACE on this one. Now, when it comes to Ferrari, obviously we all know very successful brand, right? Incredible. But at the end of the day, like the valuation on the stock has gotten very high over time. So let me go ahead and show you just how high this valuation's really gotten here recently and why I've been thinking about betting against Ferrari, and I'm so mad I didn't because I just missed a massive opportunity to make a lot of money. If we look at the trailing 12-month P and the forward P, gosh, 39 and 38, very high. Problem is the 2-year forward P is roughly in that range as well, which means there's a potential here with Ferrari where they might not get a lot of profitability expansion over the next few years. So when it comes to Ferrari, this company's been firing on all cylinders, in terms of their financials for the last several years. And it's been amazing, right? They've had phenomenal growth, a lot of double-digit growth on a year-over-year basis. And you look at their numbers, they're incredible. Look at their margins, right? They've been up very nicely. Look at their earnings per share trend. This is what analysts are expecting here. But we have a problem with Ferrari. And it really has nothing to do, look at the shares outstanding been going down. This is phenomenal across the board, right? But the issue with Ferrari has nothing with what's been going on at Ferrari for the last few years. The problem with Ferrari is what might happen over the next few years. Because you got to understand, for somebody like Ferrari, they're always counting on selling the new cars to the next bunch of individuals or the same bunch of individuals, right? But the issue is, and I'm in the Ferrari community now because I bought a Ferrari last year, right? I got to tell you guys, the commentary around the new models have been horrible. This is like their new flagship car that they showed off, right? Supposed to be so exciting, the F80. Like, oh my gosh. Like, at the end of the day, like, I looked at the commentary out there around this car, and it's horrible in regards to the look of the car. Additionally, being a V6 powertrain, like, people are like, what, a V6? And this is the flagship car? Like, what are we talking about here? So people don't like the way it looks. People think it looks like a Lego car. People don't like the V6 thing, and so it just brings a lot of negativity around the brand here, okay? Additionally, just last month, they showed off their 849 Testarossa, which was a play on kind of the, very nostalgic Ferrari Testarossa that came out. I think that was back in, when did the original Testarossa come out? I think that was back in the late 80s, I want to say. Mid to late 80s, if I recall. But I remember there was two cars when I was a little kid that were kind of like dream cars. One was a Ferrari Testarossa and the other was a Lamborghini Diablo. Like those were just two such iconic cars when I was a little kid, essentially, right? But, they showed off this car and this one didn't hit it either. A lot of people didn't like the way this one looked. They thought it looked just didn't get you excited. Like you saw it and it's like, wait, this is a Testarossa? Like this is a play on this historic car? So that has a lot of, kind of negative vibes around it as well. They also keep putting in these electric motors, which people are not into. They also keep taming down how the engines sound. People want these cars to be loud. They want them to be loud and proud. They want them to sound just insane. And so they keep kind of sounding worse. They're putting in these, partial EVs. And people are just they don't want that. And they keep trying to focus on just trying to make it as fast as possible. But yet people love a fast car, but it's just at some point it doesn't make that much of a difference between, going 0 to 60 in, 2.9 seconds or 2.4 seconds. It's just fast, right? So that's all going on. And it's just leading to a lot of negativity around the brand. And this is also ultimately ends up leading into sales problems, right? Where people I had a potential within minutes of this vehicle coming out, I got a text from Ferrari Las Vegas and listen, they wanted to get me down on that list, get me ready to buy one of these, right? And I looked at the car and I'm like, I don't even know how much this is actually going to be. And I was like, no, there's actually some older Ferrari models I actually want more than this one that I would actually rather have. So at the end of the day, this leads to a potential problem coming with Ferrari sales down the road and a potential problem with growth rates, right? Now, if the stock starts going down and you start having some sales numbers be a little weaker, what's going to end up happening is you're going to start getting a lot of people talking about this on social media, a lot of YouTube videos, Instagram videos, TikTok videos, things like that, right? That's a very popular genre of people talking about the end of this brand and the decline of blah, blah, blah company, right? I've seen it with every stock that goes down big, it seems like that happens nowadays, or every company that goes bankrupt or just has some financial troubles, and these things get millions of views. And so this is going to likely end up happening with Ferrari over this next bit of time. If this stock continues to trouble and then the numbers start getting a little, weakening, you'll end up being in a situation where you'll start to get so much negativity around Ferrari's brand. Ferrari's management team is going to hate that. That's going to be a whole situation to deal with. And so the moral of the story is here in regards to race, it's not looking great. The good news is for race is they always have a certain amount of customers that will buy every single new Ferrari that comes out, because they don't want to basically like go down in the list to get the special allocations. But I think because they missed so bad on this F80 that I actually think customers might not be as incentivized as in the past as far as trying to keep on those lists, because they're looking at the F80 and like, this isn't even really that special. Like, what are we like? We're spending $10 million, $20 million on Ferraris over the years, all to get a Lego car. Like, what is this, man? So that's just something to kind of keep with a V6. Like, a lot of people are not excited about that car. So that's something to keep in mind there. Now, there's a bigger problem in general out there, and this is luxury brands have been kind of struggling the last few years. Like, this is a 4.5-year chart for LVMH, Louis Vuitton, right? And what we find here in regards to Louis Vuitton is the stock in the last 4.5 years, roughly, is down 20+%, right? That's a very weak performance for that stock overall. I believe also Rolex prices have started to go down on the far majority of models, have gone down substantially in the past few years here, with only the very most rare models really holding value. So you've got a problem with luxury. And this gets into a bigger problem we have in general here, right? Which a bigger problem in general we have is we have gold at all-time highs, silver at all-time highs, a stock market at all-time highs. We have crypto at all-time highs. Even like international stock markets for the most part are all at all-time highs right now. And yet vehicle sales are not, that great. Luxury sales in general for handbags, luxury sales for watches, things like that are having a lot of trouble here. Home sales are having trouble even on the high end. High-end furniture is having trouble. Look at RH stock for a perfect example of that. So we have a weird, very strange thing going on where the rich are richer than ever, right? The top 10% of the wealthy, right? Richer than they ever been. But yet people aren't feeling like, I want to go buy a new Rolex. I want to go buy a new Ferrari. I want to go buy a new house. I want to go buy new furniture. So we're in very strange times right now where a lot of those spending numbers are not great. So I don't know what to think, and I don't know why that is. I really don't know why that is. Like, why is it, people are richer than ever, but they're not really out there spending like it? And my guess is I think real estate matters so much to the psychology, especially in the United States of America. And I think because real estate prices have started to trend down across countless cities, across the United States now at this point in time, and real estate sales numbers have been, pretty much a great financial crisis numbers. I think it matters a lot to the psychology of even a high net worth individual, right? That maybe has $15 million, in a net worth, but they kind of don't feel like going and spending, $25,000 on a new watch right now, because they're just looking and they're like, I think real estate matters significantly to the psychology. Now, you could say interest rates maybe matter a bit. I don't know. Like, I think a lot of these high net worth individuals, they don't even care about, you gotta understand, like, for a lot of the top 10% of wealthy, interest rates are almost irrelevant, because when they go to buy a new car, they buy it cash. When they go to buy a new house, they buy it cash many times. When they go to buy new furniture, they buy it cash. When they go to buy a new $25,000 watch, they buy it cash. When they go buy a new Louis Vuitton handbag for $5,000, they buy it cash. They're not like, oh, let me take out a loan to do that. That's not what high net worth individuals really do. And so I can't blame it on interest rates. If anything, the only thing I could think is real estate. And that weakness is just leading to a weak psychology of higher net worth individuals where they're just, But then again, if you miss on these products, I heard Lamborghini's also, not in the best situation right now as well in regards to selling their SUV. That was very hot a few years ago, is turned ice cold from what I've heard now. The Temerario, I heard, isn't all that. The Revolto's pricing's crazy. So I don't know, man. It's a weird time. By the way, as far as the other potential hedges I have on here, PLTZ, that's one I currently have on. I have Walmart as a potential. I'm going to probably take that guy off, though. Tesla, definitely there, but I got more TSLZ there. Wingstop is something I looked at, but the Wingstop's come down a lot now. So Wingstop's not as interesting as it was, man. I was looking at that one back here at the end of 24. I missed it. It doesn't mean it can't go down more from here as far as Wingstop goes, but in terms of the big opportunity in Wingstop, I missed it, man. So now I feel like I'm chasing smaller money if I go against Wingstop now. See, now the forward P is down to 40 on Wingstop, right? You know, if they continue to grow a lot of locations and grow restaurant sales, like a 40 is not insane. Now you can say maybe it should contract more, maybe go down another 10, 20%. That's possible, but the biggest money's been missed, man. I should have got in that one. I looked at it back around that September time frame. I was really considering hedging against it. It was 400 plus at that time, and gosh, I missed it. It is what it is, right? Palantir, we already talked about that one, right? Hood is interesting, but Hood I can't step in against yet. Hood's scary, man. And the reason Hood's scary is they got this relationship with, from my understanding, Kalshi, which has been blowing up as far as like a predictions market for betting on, you know, like almost like betting on sports events and whatnot and other different events. And from my understanding, like Robinhood's making very small amounts of money on each one of these deals, but it's like there's so much volume going through that it could end up benefiting Robinhood's base in a substantial way. It could get a ton of people to use Robinhood as well. So Robinhood's actually one I'm scared to bet against right now. I have it on my potential hedges watch list, but that one's scary. Palantir doesn't scare me. I'm like, okay, maybe they have one more quarter where they accelerate that growth, but then growth, stops accelerating from there or has trouble. Tesla doesn't scare me at all, not even remotely. But Hood scares me, actually. Hood scares me. That's the one I'm actually scared to step in because I'm like, dude, like so many people love to bet on sports and that Kalshi's been just blowing up. So I'm a little worried in regards to that one. Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with. If you look at the market this year, right, the S&P 500's up about 14.5%. It's been a good year. It's been a good past year for the S&P 500. There's no debating that, right? Like, this isn't a great year. It's not like this is like, whoa, this is some insane year. S&P 500's up 20, 30% over the past year. But 14.5% over a 1 year, you'll take that every time. If you tell me the S&P 500 can go up 14.5% every 1 year, I'll say go. I'll take that. Like, I don't need more than that. That's fine with me. I can make so much money in a market that goes up 14% a year. Like, with the sort of stocks I get positioned into, I'll gladly take that, right? But here's the thing you got to understand is when you have a market that's gone up a lot, you're going to have a lot of people that do what, right? Lots of profits being made. So that means lots of profits are going to be taken. Now, when you take a profit, guess what happens? You have to eventually pay taxes on that. Very, very important. A stock market that's been uptrending like this, people are going to take profits. Remember, a lot of people are not long-term investors. They're traders, and traders are taking profits all the time, right? And then you got a lot of investors like myself that maybe were positioned into stocks for years and years and years, and some of those stocks have maybe gotten overvalued now. And so I'm like, you know what? I'm taking profits out of this one, this one, this one. Not every stock in this market's overvalued. There's some that are significantly undervalued, but there's some that's no doubt in my mind they're very overvalued now at this point in time, right? So if you look at the public account alone, I've taken $668,000 of profits here in 2025, right? Which means I've got a lot of taxes to pay come April, right? A lot of taxes to pay. But what I don't do, but what a lot of other people do, a lot of fund managers, investors in general, do you know what they do? They do what's called tax loss harvesting. So they'll essentially take a stock in their portfolio or multiple stocks in their portfolio, and let's say they're down on those positions, they'll go ahead and sell out of those stocks, take those losses, so then they can write those off against their gains. And this creates a dynamic where let's say me in the public account there, let's say, I got those $668,000 in gains. So I'm saying, you know what? I need something to limit my tax bill that's coming, right? So I could sell a stock that hasn't done well, right? I don't have very many stocks that haven't done well, but I could pick one of them and be like, okay, I'm sitting at a $50,000 loss on this stock. Let me go ahead and write that off against my $670 gain. So now I only have let's say $620,000 gains, which is much less. Now this creates a brutal dynamic in the stock market where essentially the weak stocks get even more weak. So if there's stocks that have been going down, they've been trending down, right? People are going to take losses on those stocks. So the stocks that have been going down go down even more. And it's a vicious effect that many times hits in Q4. Many times it can hit in November, December. And when you get the market to trend down, it gets even worse. So what's some specific examples of some stocks that I can show you that I'm very, very concerned about this effect happening, okay? And this is very widely known if you're an investor in the market, but here's the deal. Listen. RH stock, perfect example. RH stock down another 3.5% today. That's despite the NASDAQ being green here today. That's despite the S&P 500 being green, right? Over the past year, RH stock is down a whopping 46%, right? It's been selling on selling on selling for RH stock. If people are looking, fund managers, individual investors are invested into RH, right? And they're looking for something to write off some of their gains. Maybe they sold a bunch of NVIDIA shares this year and took massive gains. You got a stock like RH, you might say, you know what, let me go ahead and cash out of this one here in Q4. And that adds even more selling pressure on a stock that's already incredibly weak. Like this stock can't find any buying pressure on a normal day. So all of a sudden you have some people tax loss harvest. It sends the stock down even further, right? Another example of a stock, Bath and Body Works. Stock's gone down 19% over the past year. People are likely sitting on big losses here and they're looking in that Bath and Body Works like, is this stock really going up anytime soon? They're going to feel like probably not. So you're going to say, let me go ahead and tax loss harvest against this one. Let me sell out of this and write this off against some gains, right? Cava. Oh, Cava. Look at this stock. Down 52.6% over the past year. Oh my gosh, is that brutal? Like danger in regards to Cava. Like if this market trends down a bit, you'll see Cava hitting the 40s like that, right? It's just brutal. But this is a stock that, keep in mind, a lot of growth investors were invested into because they had big growth rates. The same type of person that would have bought NVIDIA stock is the same type of person that would have bought Cava stock, right? High valuations, but it's got the growth. But the growth rates have come down immensely on Cava, so everybody's flooded out of that stock. And now it's gone down 52% despite the stock market being up 14.5% over the past year. So you want to talk about stock that people might be sitting on massive losses. You could have people sitting on hundreds of thousands or millions or tens of millions of dollars of losses depending upon how heavy they went, right? And they're looking and they're like, okay, I got $6 million in NVIDIA gains. Say it's a small fund or something like that. They got $6 million of gains they've taken out of NVIDIA this year. And then their Cava position, they're down $4 million on that. I might say, you know what? Let me just cash out of this. Consumer's getting weaker. Like it's not going to be good anyways in the short term. So let me write off some of those NVIDIA gains against this, right? Whirlpool, another good example of this. That stock's down over 30% over this past year. Brutal. I mean, you just got to keep in mind, if the stock market downtrends here in Q4, it's just going to be the cherry on top when it comes to a lot of these stocks, and they'll just go down more and more, right? And so, you get the S&P 500 to go down, let's say 10% between now and the end of the year. That's not a huge move, by the way. Like 10% down, we would still be up 4% roughly, or somewhere around there roughly, right? Over a year basis. But let's say hypothetically S&P 500 goes down 10%. I mean, you're going to see you're going to see something like a Whirlpool go $60. You're going to see something like Cava go into the 40s. See something like Bath and Body Works go do-si-do, 22, maybe even lower than 22. You'll see something like RH go down 125. Maybe if the market got hit really hard, RH would go under 100, right? So just something to keep in mind there.